If you answer yes to even one of these 6 questions, your Social Security check could shrink starting this year, and most people watching right now have absolutely no idea any of these rules exist. You do not need to answer yes to all 6. 1 is enough. Stay with me because question 4 is the one almost nobody knows about until the letter shows up and the money is already gone. Let me start with a real story because it puts a human face on what happens when these rules go unexplained and people get blindsided by a system that sends the bill before it bothers to offer the explanation. Margaret Holloway lives outside of Columbus, Ohio. She is 68 years old. She had been collecting Social Security disability benefits for several years when she received a notice in the mail demanding repayment of more than $22,000 in overpaid benefits. She told a local television reporter that she went into immediate shock when she opened the envelope. She said she read it 3 times and still could not understand what she had supposedly done wrong. When she eventually got through to someone at the Social Security Administration and asked them to explain what caused the overpayment, the representative could not point to a specific reason. They told her the calculation had been reviewed and she owed the money. No further explanation was offered. No timeline for when the error supposedly began was given. Just a balance due and a deadline. Margaret's situation is not unusual. The Social Security Administration's own Office of the Inspector General has documented that tens of thousands of overpayment cases in a single recent year were caused by the SSA's own internal calculation errors, not by anything the beneficiary did wrong or failed to report. And yet the bill goes out the same way regardless of what caused it. Keep Margaret's story in mind as we go through these 6 questions, because by the time we reach question 2, you will understand exactly what the rules currently are when that kind of notice arrives in your mailbox, and what your options are before the withholding begins. Question 1. Are you collecting Social Security before your full retirement age and still working a job? This is the most common way that people who are doing everything right still end up with a smaller check than they expected. The Social Security Administration applies what is called the earnings test to anyone who is collecting retirement benefits before reaching their full retirement age. The rule is straightforward, but most people who are subject to it do not know it applies until they have already triggered it. According to the Social Security Administration's 2026 earnings test thresholds, if you will not reach your full retirement age at any point this year, the SSA withholds $1 in benefits for every $2 you earn above $24,480 annually. If you will reach your full retirement age at some point during 2026, the threshold jumps significantly to $65,160, and the withholding rate drops to $1 withheld for every $3 earned above that threshold. Let me put those numbers into a real household budget to make the impact concrete. Picture a 63-year-old who claimed Social Security early at 62 because they needed the income. Their monthly benefit is $1,840. They take on a part-time job paying $48,000 per year because the benefit alone is not covering their expenses. That income is $23,520 above the $24,480 threshold. Under the 2-for-1 withholding rule, $11,760 of their annual benefit is withheld. On a monthly basis, that works out to roughly $980 per month withheld, which essentially cuts their benefit in half. The actual check they receive is closer to $860 per month rather than the $1,840 they were expecting. Now picture someone who is 65 and will reach their full retirement age of 66 and 8 months in a few months. They earned $72,000 in the months before their birthday. That is $6,840 above the higher threshold. At the 3-for-1 withholding rate, $2,280 is withheld for the year, a much more manageable reduction, and a fraction of what the person in the first example faces. The reassuring piece that the SSA does not advertise clearly enough is that the withheld money is not permanently lost. Once you reach your full retirement age, your monthly benefit is recalculated to credit you for every month that benefits were withheld. That credit increases your ongoing monthly payment for the rest of your life, and over time you recover most of what was withheld. But the recovery happens on the SSA's schedule, not yours, and it does not help you if rent was due the month the withholding hit and your check was $400 short. The practical fix, if this applies to you, is to call the Social Security Administration at 1-800-772-1213 and report your estimated annual earnings before the situation becomes a problem. The SSA can adjust your monthly benefit proactively to account for the estimated withholding, so you receive a consistently smaller check throughout the year, rather than receiving full checks and then suddenly receiving nothing when the SSA catches up to your actual earnings. There's also something worth understanding about how the earnings test interacts with your full retirement age calculation that most people who are subject to this rule have never been told. The full retirement age for people born between 1943 and 1954 is 66. For people born between 1955 and 1959, it is 66 and a specific number of months depending on birth year, ranging from 66 and 2 months for those born in 1955 up to 66 and 10 months for those born in 1959. For anyone born in 1960 or later, full retirement age is 67. Why does this matter for the earnings test? Because the higher threshold, $65,160 in 2026, applies only in the calendar year during which you reach full retirement age. And critically, only earnings from the months before your birthday in that year count toward the threshold in the year you turn your full retirement age. Earnings in the months after your birthday in that year are not subject to the earnings test at all, and going forward from the month of your full retirement age birthday, you can earn unlimited income without any withholding, regardless of how much you make. This timing detail matters enormously for someone who is planning when to take on higher earning work. If you are 65 and will reach full retirement age in 8 months, strategically timing when you take on a higher paying job to begin in the month of or the month after your birthday, rather than before it, can eliminate the earnings test issue entirely. That is not a loophole. It is simply understanding how the rule works and making informed decisions based on that understanding. Question 2. Have you ever received an overpayment notice from the SSA, even one you thought was resolved? This is the question that changed twice in just the past year, and most people watching this have not kept track of which version of the rule is currently active, which means they also do not know what their options are if they receive a notice. Here is the timeline you need to understand. In March of 2024, the SSA implemented a policy capping automatic benefit withholding for overpayment recovery at 10% of your monthly benefit. That policy was put in place after years of reporting on cases where people had their entire Social Security check withheld for months to recover an overpayment, leaving them with no income whatsoever for extended periods. The 10% cap was a meaningful protection for people on fixed incomes who had no other financial cushion. In March of 2025, that 10% cap was reversed. The SSA briefly moved to withholding 100% of benefits until the overpayment was fully repaid. That policy triggered immediate and widespread public backlash, as reports emerged of seniors and disabled individuals suddenly receiving no monthly payment at all, while the SSA recovered overpayments that, in many cases, had been caused by the agency's own errors. After that backlash, the SSA settled on the rate that is currently active. As of 2026, the SSA withholds 50% of your monthly retirement benefit automatically, beginning approximately 90 days after the notice is issued, if you do not take action within that window. For SSI recipients, the automatic withholding rate is 10%. Now let me tell you what most people facing an overpayment notice do not know. You have 3 distinct options for responding, and the one most people are aware of is not the most powerful one. The first option is to file Form SSA 561 to request reconsideration of the overpayment determination itself. This is the appeal. You are arguing that the overpayment was calculated incorrectly, that the amount is wrong, or that an overpayment did not occur at all. If you have documentation supporting your position, this is the form that initiates that review. The second option is to file Form SSA 634 to request a reduced repayment rate. This is not an appeal of whether the overpayment occurred. It is a request to repay it at a lower rate than the 50% automatic withholding, on the grounds that 50% creates genuine financial hardship. If your monthly Social Security is $1,400 and 50% withholding would leave you with $700 to pay rent, utilities, food, and prescriptions, the SSA has the authority to negotiate a lower monthly repayment amount. The third option is to file Form SSA 632BK to request a complete waiver of the overpayment. A waiver asks the SSA to forgive the debt entirely on 2 grounds: that the overpayment was not your fault, and that repayment would cause genuine financial hardship. If the SSA's own internal error caused the overpayment, as happened in tens of thousands of documented cases, the fault condition is often straightforward to establish. The hardship condition requires demonstrating that your income and assets are insufficient to repay the debt while maintaining a basic standard of living. The critical thing to know about all three options is timing. While any of these requests is pending review, the SSA is required to pause withholding. That means filing fast matters more than filing perfectly. If you receive an overpayment notice and you are within the 90-day window before automatic withholding begins, your priority is to get one of these forms submitted as quickly as possible to trigger the pause. You can refine your argument and provide additional documentation after the hold is in place. Let me walk through each form in more detail so you understand what you are actually submitting and what documentation is most helpful to include. When you file Form SSA 561 to request reconsideration, you are asking the SSA to review whether the overpayment determination was correct. The most common grounds for this request are that the SSA miscalculated the amount of the overpayment, that the SSA calculated the overpayment for a period during which you were actually eligible for the full amount you received, or that the SSA identified the wrong triggering event. To support a reconsideration request, gather any documentation you have showing your income, resources, and living situation during the period the overpayment allegedly covers. Bank statements, income records, pay stubs, and correspondence from the SSA from that period are all potentially useful. If you received any written confirmation from the SSA during that period that your benefits were correct, that documentation is particularly valuable. When you file Form SSA 634 to request a reduced repayment rate, you are not disputing whether the overpayment occurred. You are asking the SSA to agree to recover it at a lower monthly amount than the 50% automatic withholding because the current rate creates financial hardship. To support this request, document your monthly income and monthly expenses in detail. Show the SSA what you actually have coming in, what your essential expenses are, and what would be left after 50% withholding. If the answer is very little or nothing, that is exactly the hardship condition the form is designed to address. The SSA has authority to negotiate repayment as low as $10 per month in extreme hardship situations, though they do not advertise this flexibility. When you file Form SSA 632BK to request a complete waiver, you need to establish two things: that the overpayment was not your fault, and that repaying it would cause genuine financial hardship. The fault question is often the most important. If the overpayment was caused by an SSA calculation error, an SSA systems error, or an SSA failure to process a change you correctly reported, the fault condition is typically met. Include any documentation you have showing that you reported changes correctly and on time, and any documentation showing that the SSA's own records or notices during the period in question contradicted what they are now claiming was the correct benefit amount. One additional resource worth knowing about for anyone navigating an overpayment dispute is that every state has a legal services or legal aid organization that provides free assistance specifically with Social Security cases. A benefits attorney or Social Security advocate can help you determine which form to file, gather the right documentation, and communicate with the SSA on your behalf. You can find legal aid resources in your state at lawhelp.org. Many of these organizations have staff specifically trained in Social Security appeals and can dramatically increase your chances of a successful outcome. Question 3. Did you get married, divorced, or change who you are living with in the past year while receiving SSI? SSI, which stands for Supplemental Security Income, is a needs-based program that considers your household income and resources, not just your own. That means changes in who you live with and who you are legally married to can have direct and immediate effects on your benefit amount, in both directions. Marriage triggers what the SSA calls spousal deeming. Part of your new spouse's income gets counted against your SSI eligibility, even though it is legally your spouse's money, not yours. According to the SSA's 2026 SSI rules, the maximum individual benefit this year is $994 per month, and the maximum for a couple is $1,491 per month. If your new spouse's countable monthly income after allowable deductions comes in above approximately $497, the SSA begins treating you as a couple for benefit calculation purposes. Depending on the amount of your spouse's income, this can shrink your individual payments significantly or eliminate it entirely, even though nothing about your own financial situation has changed. What most people do not hear about is the flip side. Divorce or legal separation can increase your SSI payment because the household income used in the deeming calculation just dropped on paper. If you were receiving a reduced benefit because your spouse's income was partially deemed against you, and that marriage ends, your benefit may go back up to the individual maximum. But this only happens if you report the change within the required window. The SSA also applies a $3,000 combined resource limit to married SSI couples, even when only one spouse is SSI eligible. This catches people off guard when a new spouse's savings account, investment account, or accessible retirement funds get folded into the household resource calculation and push the couple over the $3,000 limit. Any change in marital status and any change in who you are living with must be reported to the SSA within 10 days after the end of the month in which it occurred. Missing that window is one of the most direct paths to an overpayment notice, because the SSA eventually identifies the change through their own data matching and calculates an overpayment covering all the months between when the change happened and when they discovered it. Question 4. Is a family member or roommate helping cover your rent, your utilities, or your groceries while you are on SSI? This is the question almost nobody knows about until their check comes in smaller than expected and they cannot figure out why. The SSA calls this in-kind support and maintenance, and it is one of the least understood rules in the entire Social Security program. According to SSA guidance for 2026, if someone else is paying part of your housing or food costs, the SSA can reduce your SSI payment by as much as $351.33 per month, depending on how much support you are receiving and how it is documented. That reduction is calculated as 1/3 of the federal benefit rate, and it applies to any month in which you receive help with housing or food costs from someone outside your household, or from a household member who is not also an SSI recipient. Here is what catches people so completely off guard. This does not have to be a formal financial arrangement. It does not have to be a large amount of money. An adult child who pays your electric bill one month. A roommate who covers your share of the grocery run because you are short that week. A neighbor who brings you meals regularly without you paying for them. All of these can qualify as in-kind support and maintenance, and can trigger the monthly reduction if the SSA becomes aware of them. The part that makes this even harder to navigate is that the SSA typically learns about in-kind support through the periodic redetermination process, during which you are asked a detailed set of questions about your living situation and financial arrangements. If you answer those questions accurately, and the answers reveal in-kind support that has been occurring, the SSA may calculate an overpayment going back to when the support began. There is one significant exception worth knowing in detail. If everyone in your household is receiving a qualifying public assistance benefit, which includes SSI, Temporary Assistance for Needy Families, or SNAP, the SSA generally does not apply the in-kind support reduction on the assumption that everyone in that household needs their own benefit income to meet their basic needs. This exception can make a meaningful difference for households where multiple family members are receiving various forms of assistance. Let me walk through what this looks like in practice, because the mechanics of in-kind support are frequently misunderstood in ways that cost people money. An SSI recipient who lives with her adult son in his home and pays no rent is receiving in-kind support in the form of free housing. The SSA's calculation for a month in which she received the full in-kind support value of her housing is to reduce her SSI payment by 1/3 of the federal benefit rate, which in 2026 works out to approximately $331. Her maximum benefit before the reduction is $994 per month. With the full in-kind support reduction applied, she receives approximately $663. But here is what most people in this situation do not know. There are ways to structure the arrangement that reduce or eliminate the in-kind support determination. If she pays her son any amount of money toward her actual share of household expenses, including rent, utilities, or food, and that amount is at least equal to what the SSA would otherwise deem as the in-kind support value, the reduction may not apply or may be significantly reduced. The calculation is complex and depends on the actual household expenses, but the key point is that even a small formal rent payment, documented and paid regularly, can sometimes eliminate the in-kind support determination entirely. If your living situation involves any form of help from family members with housing or food costs, a conversation with a benefits counselor or SSA representative to understand how your specific arrangement is being classified is worth having before you receive a notice. Many people in this situation have been receiving a reduced benefit for years without knowing why, and in some cases, without knowing that the reduction was related to their living arrangement at all. If you are not certain whether your current living situation qualifies for the Household Public Assistance exception, or if you are genuinely unsure whether help you are receiving from family members rises to the level of in-kind support, that is a specific question worth putting to an SSA representative or a benefits counselor rather than guessing. Getting it wrong in either direction creates problems. Question 5. Do you have more than $2,000 in countable resources as an individual or $3,000 as a couple while receiving SSI? This limit has not been adjusted since 1989. If it had kept pace with even modest inflation, the individual limit would be sitting above $5,000 today. Instead, it remains frozen at exactly the level it was set nearly 4 decades ago, which means the same modest savings cushion that felt completely safe for most of the 1990s and early 2000s can now disqualify a recipient without warning as financial circumstances shift. The SSA evaluates your countable resources on the first day of every month. That timing creates a specific and frequently overlooked vulnerability. A large tax refund that arrives on January 12th and is spent down entirely by January 31st can still trigger a month of SSI ineligibility for January if your account balance on January 1st was already close to the limit. A holiday cash gift from family, an insurance reimbursement check, or a retroactive benefit payment from another program can all temporarily push someone over the limit for the month they arrive, even if the money is genuinely needed and is spent immediately. Understanding what does and does not count toward the resource limit is important and worth going through in some detail, because the categories that do count are more varied than most people realize. Your primary home does not count regardless of its value, as long as you are living in it or intend to return to it. One vehicle does not count regardless of its value, as long as it is used for transportation. Personal property and household goods generally do not count. Irrevocable burial plans and burial plots generally do not count up to certain limits. What does count? Any additional checking or savings accounts beyond what is excluded. Certificates of deposit, stocks, bonds, or mutual funds, cash on hand. The cash surrender value of life insurance policies if the total face value of your life insurance policies exceeds $1,500. Accessible retirement accounts in some circumstances. Certain trust arrangements depending on how they are structured and who controls the disbursements. The life insurance policy rule trips people up more often than almost any other part of the resource calculation. If you have an old whole life insurance policy that has accumulated cash value over the years, and the total face value of all your life insurance policies combined exceeds $1,500, the cash surrender value of those policies is a countable resource. Many SSI recipients in their 60s and 70s have life insurance policies they took out decades ago that have accumulated significant cash value without them realizing that the cash value was always a countable resource that should have been reported to the SSA. If you are currently receiving SSI and you have a life insurance policy with accumulated cash value, confirming with the SSA that this has been correctly accounted for in your resource determination is worth a phone call. If the cash value has never been reported, you may be in an ongoing overpayment situation that you are not aware of. If you are approaching the resource limit or are concerned about a payment you are expecting, the legal tool designed specifically for this situation is an ABLE account. As of 2026, any individual whose qualifying disability began before age 46 can open an ABLE account, and the first $100,000 held in an ABLE account is completely excluded from the SSI resource count. For SSI recipients who have a disability that began before age 46, an ABLE account is one of the only legally available ways to build meaningful savings without risking their eligibility. Contributions can come from the account holder, from family, or from others, up to the annual contribution limit, which in 2026 is set at $18,000 per year. The funds can be used for a broad range of disability-related expenses, including housing, transportation, education, healthcare, employment support, and assistive technology. If you are currently an SSI recipient and you are not using an ABLE account, and if your disability began before age 46, this is worth investigating immediately. It may be the single most powerful financial tool available to you for building a financial cushion while maintaining eligibility. You can find information about ABLE accounts and how to open one at ableirct.com and at your state's ABLE program website, as most states now operate their own ABLE programs with specific rules and contribution structures. Question 6. Did you forget to report a change to the SSA within the required reporting window? Whether it was income, an address, a marital status change, a change in your living arrangement, a new vehicle, a new bank account, or anything else that affects your eligibility or benefit calculation, the SSA requires most changes to be reported within 10 days after the end of the month in which they occurred. Missing that reporting window is the most common single trigger for overpayment notices in the entire Social Security system. Not fraud, not deliberate concealment, simply not knowing that a change needed to be reported or not reporting it within the required time frame is responsible for a very large share of the overpayment cases that result in the 50% withholding that is currently active for retirement benefit recipients. The reason the reporting window matters so specifically is that the SSA calculates overpayments from the first month in which you were no longer eligible for the benefit you received, or in which your benefit should have been lower than what you received. If you had a change in January and did not report it until June, the SSA calculates an overpayment for all 5 months between January and June, even if you would have reported it immediately had you known it was required. Let me give you a concrete list of changes that SSI recipients specifically are required to report, because the list is longer than most people realize, and several of the items on it are things that people genuinely would not think to report without being told. Changes in earned income, meaning any change in wages from employment, need to be reported. Changes in unearned income, including any new sources of income, changes in the amount of existing income sources, or changes in how income is received, need to be reported. Changes in your living situation, including moving to a new address, moving in with someone, or someone moving into your household, need to be reported. Changes in your resources, including opening a new bank account, receiving a large cash gift or inheritance, purchasing or selling a vehicle, or any other change in your countable assets, need to be reported. Changes in marital status, including marriage, divorce, separation, or the death of a spouse, need to be reported. Changes in citizenship or immigration status need to be reported. Changes in your incarceration status, including entering or leaving a jail, prison, or correctional facility, need to be reported. And any change in the status of your disability, including improvement in your condition or the beginning or end of treatment, needs to be reported. The good news is that reporting is generally fast and straightforward. You can do it through your My Social Security account online at ssa.gov, by calling 1-800-772-1213, or by visiting your local SSA field office in person. The online reporting option is typically the fastest for most types of changes and creates an immediate record of when you reported that can be valuable if questions arise later. If you are unsure whether a specific change in your situation needs to be reported, the correct approach is to call and ask rather than to wait and assume. The SSA representative can tell you whether the change affects your eligibility or benefit amount. The conversation creates a documentation record that can be helpful if questions arise later, and the cost of making an unnecessary report is zero, while the cost of failing to make a necessary report can be thousands of dollars in overpayment liability. There is one final piece of practical advice that applies to all 6 of these questions equally, and it is the piece that ties everything together. The Social Security system is complex. The rules change frequently, and the SSA is not structured to proactively explain to each of its 60+ million beneficiaries how every rule applies to their individual situation. The people who navigate this system without major disruption are the ones who know enough to ask the right questions before a problem develops, not after. If you watched this video and recognized your situation in any one of these 6 questions, the right next step is a phone call to the SSA at 1-800-772-1213 to ask specifically about how that rule applies to your situation today. Not what the general rule is, which you now know, but how your specific circumstances are being handled within that rule, and whether there is anything you need to do, report, or file to protect your monthly benefit. None of these are theoretical risks. They are the current active rules as of 2026. The SSA is not going to call you to walk you through which ones apply to your specific situation. That is not how the system works. The system processes your benefits based on what it knows, and when something does not align, it generates a notice and expects you to respond correctly within the deadline. The knowledge of what the rules are and what your options are when you receive a notice is the only thing that separates the people who navigate this system without major disruption from the people who find out how it works only after the disruption has already happened. Share this with someone you know who is on Social Security, SSI, or SSDI right now, because the odds are genuinely good that at least one of these 6 questions applies to their situation and they have no idea. And subscribe so you are among the first to know when any of these rules change again, because in 2026, they have already changed more than once and the year is not over. I will see you in the next one.